Welcome back to another explainer. Today, we're tackling something literally every trader's going to face at some point, but very few actually master: the secrets to avoiding ruin. If you've spent any time in the markets, you probably know that feeling, right? That shared, sinking, punch-to-the-gut pain of blowing up an account in just one bad day. You grind for months, compounding those wins, and then, bam, one catastrophic mistake wipes out years of progress. It is absolutely brutal. But what if I told you the best traders in the world don't necessarily have better strategies? They just have entirely different frameworks for survival.
Okay, let's dive into this. So what exactly are we trying to avoid here? When we talk about risk management, most people just assume it means, slapping a stop loss on a chart and crossing your fingers. But true risk management, it goes way deeper than that. It targets unacceptable outcomes. It's all about intelligently controlling your exposure so that you actually stay in the game long enough for your edge to play out. The legendary trader Paul Tudor Jones hit the nail on the head when he said, "No one loses money because of bad strategy. They lose money because of bad risk management." I mean, that perfectly sets our foundation for today. We have to shift our mindset away from constantly obsessing over maximizing profits and instead strictly prioritize survival. Simply put, you cannot win the game if you get knocked off the board.
Here is our roadmap for the explainer today. First, the reality of ruin. Then, eliminating the big loss, the math of position sizing, protecting against yourself, the ultimate defensive hack, and finally, shifting to offense.
All right, starting off with Section 1, the reality of ruin. Trading is incredibly unique, mostly because it's one of the very few professions out there where a single terrible day can literally undo years of meticulous, hard work. The market really only has to kill you once. So risk of ruin is defined as a loss large enough to destroy your confidence, impair your decision-making, and create an unrecoverable financial blowup. And it's totally unique to your own personal financial and psychological tolerance. For instance, for a massive pension fund, a 20% drawdown might be absolute ruin. But for an undercapitalized retail trader looking for super aggressive growth, ruin might look more like a 100% total wipeout. And this brilliantly illustrates exactly why drawdowns are so incredibly dangerous. Just as gains snowball upward, losses spiral downward with this brutal exponential force. Think about it. If you take a 50% loss, you don't just need a 50% gain to get back to where you started. No, you need a 100% gain just to break even. Drop 80%, you're going to need a staggering 400% return just to get back to zero. The deeper the hole, the steeper the climb.
Moving right along to Section 2, eliminating the big loss. No more catastrophes.
Since we know the math of massive drawdowns is basically a death sentence, our primary job is to mathematically guarantee those kinds of losses simply cannot happen. Whenever you enter the market, you're essentially walking away with one of four results, right? A big profit, a small loss, or a big loss. Those are literally the only possible realities.
But here's the reality check. Small profits and small losses essentially just cancel each other out over time. It's the big profits that actually grow your account and create outsized wealth. So if we simply eliminate that big loss, you instantly solve 90% of your trading problems. Your entire system should be designed from the ground up to ensure that fourth outcome, the big loss, is literally impossible.
So how do we actually do that? Well, we take some advice from market wizard Bruce Kovner. He famously said, "I know where I'm getting out before I get in. It's the only way I can sleep." Before you even think about hitting that buy button, you must have a predefined point where your trade thesis is officially invalidated. Without knowing exactly what you stand to lose, it's mathematically impossible to quantify your expected value. And this leads us to the great debate: hard stop losses versus mental stop losses. Now, a mental stop relies entirely on your own real-time discipline, which, let's be honest, is super dangerous. The human brain is exceptionally good at rationalizing losses when real money's on the line. On the flip side, a hard stop loss is an automatic order resting in the market. It protects you from hesitation, from emotional paralysis, and from those sudden catastrophic tail events. When the pressure is on, our emotions are just too feeble. You've got to automate that off switch. All right, Section 3, the math of position sizing. This is your ultimate cheat code.
Now, I know formulas can feel a bit dry, but treat this as the absolute ultimate cheat code for financial survival. Stop losses are great, sure, but position sizing dictates how much damage a mistake can do before the mistake even happens. Here is the exact calculation used by top professionals to guarantee survival. Step 1. Determine your risk per trade, or RPT. This strictly needs to be between 1 and 3% of your total account capital. Period. Step 2. Define the exact price of your stop loss. In Step 3, divide your RPT dollar amount by the stop loss point difference. The result? That's the exact quantity of shares or contracts you're allowed to buy. It entirely removes the emotions from sizing up.
Now, what's really fascinating about this data is that it gives us the statistical proof of why that 1 to 3% limit is totally non-negotiable. For a trader with a solid 50% win rate, statistically speaking, out of every 8 trades, you will hit a streak of 3 consecutive losses. Out of 32 trades, you are practically guaranteed a streak of 5 losses in a row. So if you're out there risking 10 or 20% of your account on a single idea, this perfectly normal mathematical variance is literally going to guarantee your destruction.
Let's get into Section 4, protecting against yourself and dealing with your own biases.
Okay, so now that we have the math dialed in, we have to deal with the ghosts in the machine, our own psychological biases. Things like FOMO, tilt, anchoring, overconfidence. Markets are highly emotional environments that trigger these biases perfectly and usually right when your risk is at its absolute highest. To fight this, elite traders build hierarchical if-then rules. This starts with automating a daily loss limit directly with your broker so you literally cannot override it in a moment of panic. It includes rules like, if I hit a 10% drawdown, I take a mandatory 1-week break, or if I lose $1,500 intraday, I cut my position size by 50%. It even includes doing a daily pre-market emotional temperature check. If you slept terribly or you're feeling stressed, you proactively cut your risk before the opening bell even rings.
Another crucial way to protect yourself is deeply understanding the asymmetric danger of different strategies, specifically the difference between going long and going short. See, when you go long, your risk is finite, right? A stock can only go to 0, but when you go short, your downside risk is theoretically infinite. We have seen massive, uncapped upside dislocations in names like Avis Budget Group, where force covering creates this near vertical move that can blow up an account in the blink of an eye. You must size your shorts far more conservatively than your longs, for sure.
Section 5. The ultimate defensive hack for protecting your wealth.
We've talked a lot about math, stop losses, and rules, but there is one incredibly powerful tool that most retail traders completely overlook, and that is wiring out your profits. Listen, unrealized gains in your account are just numbers on a screen. They're still at risk. When you actually wire out profits to a bank account or a passive investment, you secure that life-changing money against unpredictable black swan events. But even more importantly, it creates the psychological firewall between your speculative trading self and your actual long-term financial future. It massively stabilizes your emotional baseline.
Finally, Section 6. Shifting to offense through dynamic bet sizing.
So once your defensive fortress is built, survival alone isn't going to be enough. You can't win a game playing permanent defense. Eventually you have to score. The crucial point here is dynamic bet sizing. Larger edges deserve larger bets. Think about it like poker. If you're an elite player who always bets tiny amounts even when you're dealt pocket aces, you are mathematically failing to maximize your expected value. Trading is really no different. Treating mediocre setups and elite setups identically is just a deeply flawed approach.
The very best traders are constantly adapting to their environment. They strictly identify their absolute A-plus setups versus the mediocre ones. They aggressively increase their exposure when probabilities heavily align in their favor, and conversely, they aggressively scale back their size in choppy, random markets. And what happens when they hit a slump? They shift entirely into research and development mode. They recognize that sometimes the absolute highest expected value decision you can possibly make is just sitting on your hands.
I want to leave you with this provocative question to really chew on. Are you optimizing for the quick thrill of a single trade, or are you focused on surviving long enough for your true edge to actually compound? Risk management isn't just the thing that prevents failure. It is the very foundation that makes your long-term success possible. Master these cheat codes, build your defenses, and then, when the conditions are absolutely perfect, strike hard. Thanks for joining me on this explainer, and I'll catch you in the next one.